Categories of debt mutual funds that outperformed when yields were rising may not necessarily be the ones that do well once interest rates stabilize or start coming down. So don't select a debt fund category based on past returns alone. Also, when selecting an individual fund, don't go just by its yield. A fund may be offering more yield because it is taking more risks. These were some of the insights shared with us by Mr. Sandeep Yadav, Head of Fixed Income at DSP Mutual Fund. In a wide-ranging interview, Mr. Yadav also spoke about where inflation and interest rates are headed and how a novice investor can go about building a debt mutual fund portfolio.
Good afternoon and welcome to our show. Our goal for this interview will be we'll first discuss the monetary policy review, and then we will discuss how retail investors should go about investing in debt mutual funds. My first question is, in the December 7 monetary policy review, the RBI chose to hike the repo rate by 35 basis points instead of the customary 50 basis points. What was the reason for this lower rate hike?
Well, good afternoon, Sanjay. I think there were multiple reasons for that. I think the primary reason, of course, is that inflation is coming lower. Inflation is currently at the handle of around 6.5%, and a few months back it was at around 7.5%. So it's fallen drastically. On the second hand, we have also seen that federal banks across the world, especially US Fed, have also tamed down their rate hikes. It used to be 75 basis point about a few months back, and right now they're doing 50 basis point rate hikes. So somewhere RBI cannot be an outlier and continue to be in the kind of aggressive posturing that they were doing earlier. So looking at both these two events, it's unsurprising that RBI has also come up with a 35 basis point rate hike, which is much lesser than the 50 basis point rate hike that we've been doing so far.
The market widely expected that the RBI would signal the end of rate hikes, but it did not do so. Why did it take this? Why did it not signal the end of rate hikes?
So Sanjay, as I mentioned, the inflation is lower, but unfortunately, lower inflation does not mean low inflation. And currently, inflation is much above the comfort level of RBI, which is usually around 6% on the upper tolerance band. And as I mentioned in my previous answer, that RBI cannot be an outlier and has to somehow tango with what the other central banks are doing. And even if we see outside India, most of the central banks, why they have reduced the size of the hikes, but they have also not cut down on the hikes. And we expect future hikes from other central banks. So somehow this is quite much in line to what other central banks and to what internal macroeconomics and inflation are showing. And most probably because of these two reasons, RBI has continued to not signal a pause.
What are your expectations regarding future rate hikes? How many more and of what quantum?
Well, we certainly expect a 25 basis point rate hike. We expect other central banks also to keep on raising for the next quarter, and we expect RBI to at least do a 25 basis point rate hike. What will decide any other future further quantum are largely two things. The first one is, of course, dollar rupee. As dollar rupee literally reflects the difference between the policy of RBI and the policy of the other central banks, because that leads to differential in the capital flows. So we believe a large part will depend on how aggressive the other central banks are going and how it impacts our dollar rupee levels. The second is, of course, inflation. The reason I say inflation is, even if we look at the recent RBI monetary policy, it has been very clear that inflation is looking to come down, but there are a lot of uncertainties. For instance, they have mentioned quite consistently about the rabi crop and the monsoon, that the monsoon ought to be normal for the projections to hold. And as we all know, in India, this agriculture inflation is quite difficult beast to predict. And from that perspective, if we expect a little bit of more agricultural inflation, be it because of the rabi crop, be it because of the monsoons, then we can expect a few more rate hikes along with dollar rupee, as I mentioned.
And once the rate hikes end, after that, do you expect a long pause? Or do you expect the RBI to start cutting rates? What kind of expectation would you have?
Well, largely I'll take over from where I ended the last answer, and that is that inflation is very difficult to predict. Especially in a country like India, which is an emerging market, where 50% of the CPI basket, that is the inflation basket, is nothing but food, and rest 10-15% is imported inflation like fuel and petrol and diesel. So in such a scenario, it is very difficult to predict maybe 6-7 months down the line what RBI's action would be. But largely, if we expect agriculture inflation, food inflation to remain contained, then I would personally expect RBI to remain still in pause and not to do a rate cut in a hurry. I think a large reason why we may expect a rate cut is because we've got a little bit of recency bias or anchoring bias, where a couple of years back, India's RBI policy rates were at around 335. And suddenly, 6.5 seems very, very high compared to 375. But if we historically see, around 6.5 has been the mean of RBI's policy rate. And even if we remain at 6.5 level, that is the RBI's policy rate is at 6.5 level for an extended period of time, it doesn't really sound very hawkish or very constraining RBI monetary policy. And it would be quite normal if you let go of the abnormal COVID times when we are very low in repo rate.
Now I'll ask a few questions on debt mutual funds. Currently, if you look at the past returns of debt mutual funds, returns for most categories are in the low single digit. Why is that so?
Well, it's primarily because we've seen yields rise up. As yields rise up, the prices of the bonds reduces. And in the last 1 year, we have seen yields rise up sharply. As I mentioned, a year back, RBI's policy rate was around 3.35%. Today, we are looking at 6.25%. Such a sharp rise in yield has led to capital losses in most of the bonds, where the prices have fallen down, even though the yield, that is a coupon that you get from bonds, has increased. So I think for people who may be more exposed to equity, is as good as saying that in the last 1 year, we have seen the prices of the stock fall, but we have seen the dividends, which is a coupon yield in bonds, have increased. But unfortunately, the increase in the coupon yields is not significant enough to wipe away the capital losses. And that's why we see a low single digit returns in most of the debt funds in the country, or for that matter, in the world as well.
How will returns for debt funds be in the future? Are returns likely to improve? Is this a good time to enter debt mutual funds?
Absolutely, Sanjay. I think this is a very good time to enter the debt funds. So unlike equity markets, where we see a trending market, where 20 years back, the Sensex could have been a few thousands. Today, we are in higher 20s, 30s, 40s. And similarly, in debt, in fact, unsimilarly in debt markets, we don't see the trend. Debt markets are cyclical, so yields go up and they come down. So 5 years back, the current yields, we would have seen the current yields. 10 years back, the yields would have been similar. So every 5 years, India has seen yields rise up and then they suddenly fall down. Now, why is that important? Because unlike in equity markets, where you can probably remain invested for a long period of time and you get money, in debt markets, the cyclicity means that at some times it's good time to invest, and at sometimes it's a good time to exit the market. Right now, when yields are high and we are at the same levels that we were probably 5 years back, and most probably yields are going to come lower in the coming next few years, it makes sense to invest in debt markets, because a fall in yields leads to a huge capital gain, or a large capital gain, if I may correct myself. And that's why it's a good time. We are probably at the peak of a cycle, and the next move of yields is most probably going to be on the lower end, which should mean a significantly higher returns in the debt market. So just to summarize, debt markets are basically low returns in debt markets are usually followed by high returns in debt markets. And since we've had a bout of low returns, we should be looking up for a higher returns in the next few years.
Which segment of the yield curve is looking attractive, especially attractive, or which categories of debt mutual funds should investors go for currently?
Sure. So, of course, it depends from investor to investor and the risk profile. But personally, I believe that around 5 years to 10 years segment is a very good segment. Now 5 years would, of course, have a little bit lesser risk. 10 years would have a little bit more risk. But in debts, in a debt market, a more risk does not really mean a significantly high risk. The reason I say is because, as I said, the yields are expected to come down. If yields are coming down, the longer maturity product you have, the more returns you end up making. That's why I prefer 5 to 10 years, depending on the risk profile. If you look at the kind of funds that offer these kind of bonds in their portfolio, Ideally, my personal preference remains short-term fund, because the fund and this fund, according to SEBI, these funds can take a duration of 3 years, which means a maturity profile of around 5 years bonds in the maximum. And they can, of course, reduce the risks also. Now, why I like short-term fund as a category is because you don't end up taking extreme risks. Somewhere the barriers stop you from taking those extreme risks. Similarly, I like medium duration fund in these scenarios, because again, the duration is 3 to 4 years. You can hold bonds from 4 years to 6-7 years maturity, and it really makes sense, in my opinion, when yields are already high, to be invested in these segments. Finally, the markets in the last couple of years have started offering target maturity funds, which is nothing but something like similar to an FD, but not actually an FD, where you have a little bit more reasonable expectations of your returns. And these funds usually have the end maturity of 2027 or 2028 or even 2030, depending on how long you want to remain invested. So I think these funds are very good investment in debt funds right now.
A lot of retail investors are now keen to take tactical exposure to longer duration funds. Should they do so, or would you advise against it?
I would certainly advise for it. We have also in DSP plan to launch a long duration fund in a month or so. But one needs to be careful about why they're investing in these funds. Largely, a longer duration funds has got higher risk, and now when yields are expected to fall down, the returns that one can expect in long duration funds are probably going to be higher than any other debt fund if yields actually fall down. That is why in this current scenario, long duration fund may seem enticing, and we think that probably it could be a part of an asset allocation. Though I would not say that this should be the fund that people should go as a default. This should just be used as an asset allocation fund. Why do I say that? Well, let's say if these funds are invested in a 40-year bond and yields fall down by 1%, then we are probably looking at returns in north of 20% in 1 year. Now, these are not the kind of returns that one usually gets in debt. These are the kind of returns that one gets in equity, which are much more volatile. And that is why I will say that these are not your norm. One should not expect normal debt returns in these funds, but one should use it as an asset allocation, which are slightly more volatile, but which could give you significantly more returns.
What kind of horizon should one have when entering these longer duration funds?
Well, there are two reasons that one could enter long duration funds. One is, of course, the tactical cost that we said. Yields will come down, you make capital gains, and you exit, very much like one may do in a lot of equity funds, where they may have a tactical call on one sector, and once the sector goes up, you exit. So I would say about 1.5 or maximum 2 years should be a horizon. But there's a second segment of investor who should, or who may, in my opinion, look into long duration funds, and they are the ones who are really long-term investors. You're looking for a retirement plan or a pension plan, and suddenly when you're investing in a 40-year bond, what you're getting is, then you're really not bothered about the capital gains and losses, but what you're getting is probably locking in around 7.6, 7.7% in a debt fund. Which is most probably the returns you're going to get if you live through the whole roll down of the fund. So I would say it depends on the investor profile. If you're looking for a long-term retirement or a long-term duplication of a retirement or a pension fund or similar kind of product, then you want to remain stuck over here for decades. If you're actually looking for a tactical call, then probably a couple of years is the time, because if your call has not gone right in a couple of years, probably you want to just exit it at that time itself.
Now, suppose that we have a new investor who has just begun investing in debt mutual funds. What would your advice to such an investor be on the selection of debt mutual fund categories? How should they go about building their debt mutual fund portfolio?
Absolutely. I think the first thing they need to do is probably just read a little bit about the categories of debt mutual fund. We in DSP are also coming up with a little bit of literature, but if you look around in the internet, you'll get it. Now, why do I say that? Because in debt mutual funds, the differences between mutual funds, the classification of those mutual funds can be significant. For instance, one of the lowest risk mutual fund is an overnight fund, which is as good as someone putting their money in the bank savings or current account. And the longest duration funds, which I mentioned, 40-year duration, it's literally similar to doing a FD for 40 years. So as you can see, the risk profiles are very wide. I would say that people who are entering for the first time, and if they are probably not sure where they want to invest, a short-term fund still remains a good fund to start an entry, largely because this category of funds has got boundaries, very strict boundaries of the lower duration at 1 year and maximum duration at 3 years. So these funds rarely make significant losses or significant gains because of the SEBI classification and the boundaries that are kept in that. On the other hand, probably the first-time investors may want to put in target maturity funds, which I had mentioned a little earlier, because I'm assuming that these investors already have fixed deposits in the bank accounts, and they can think about switching from those fixed deposits to target maturity funds, and then probably wait for a while and see whether they're getting higher returns in mutual funds or in fixed deposits, and then choose whatever tenor they prefer, and probably shift more allocation into debt mutual funds.
In your experience, what are some of the common mistakes that retail investors make when investing in debt mutual funds and which they should avoid?
Absolutely, Sanjay. I think there are a couple of mistakes which really come out straight away. I think one of the best examples I could give is about my wife. So about a couple of months back, she had never invested in debt mutual funds, and she was investing, and she came and she said, Sandeep, I want to invest in your, and she's a long-term investor usually. And she says, Sandeep, I want to invest in your funds, and DSP Ultra Short Fund is doing very well. And as a long-term investor, I want to invest over here. And I was quite shocked. Why was I shocked? Because Ultra Short Fund category basically just invests in 3-4 months. And if you're a long-term investor, you will not do that. And I asked her, why are you doing that? She said, because this has given the highest returns in the past 1 year. Unsurprisingly, if you don't take a risk and the yields are rising, then the funds that don't take the risk will end up getting more returns. And I think this is the mistake that people do, because they tried, most of these investors have had some experience in equity mutual funds, and then they move to debt funds. And they look at the past performance and they extrapolate the past performance and the future performance. As I said in one of my earlier answers, when yields go, debt funds perform, and then there's a bout of underperformance. Similarly, even in debt fund categorization, you'll have overnight or low duration or ultra short funds outperform other debt funds, but in the next cycle, they will underperform because they hardly take as much of risk as probably longer duration funds do. So in debt, it's usually the contrary. If a fund has, or a fund category has done very well in past few horizons, and most probably they're not going to be the best performing category in the next few horizons. So that is probably the biggest mistake that I have seen in my career, that even some of the more experienced investors make, where they look at the past returns and they try to extrapolate it. In debt, most probably, and I'm not going to use the word most probably, but usually you will see a higher performance may not lead to a higher performance in the future. So one needs to be very careful while where they're investing. And I think the second one is probably even more riskier. And that is when investors look at yield of a debt fund and they decide to invest based on the yield. Now, what is yield? Yield is nothing but the coupons that you are, in simplistic terms, they are the coupons that you're getting in a debt fund. Now, the reason it's risky is the reason you're getting a higher yield in a debt fund is probably because the fund is taking one of the 3 risks. One is duration risk. That means they're buying longer tenor bonds. Second is illiquidity risk. That means these funds are buying bonds which are probably cheaper, giving higher yield, but if tomorrow they want to exit, it is not so easy to exit. And third, which is probably a bigger risk amongst these two, is credit risk. So basically, you are investing in companies which you're not very sure, what is the probability of the chances of how much money you're going to get back. And I believe that a lot of first-time investors make this mistake of investing in funds which have got the highest yield. But they ought to be wary that if a fund is giving a very high yield, then it's probably taking some risks which other funds are not taking. So in my sense, investors have to stop chasing the YTM, and they have to stop chasing the returns, and they have to probably do a little bit more research about which category they want to, and within a category, which funds they want to. So again, category, you don't decide a category based on the past performance. And once you've chosen a category, you don't decide a fund within that category based on the highest yield.
So a lot of people also select debt mutual fund categories based on their investment horizon.
Right.
Is that the right approach to take?
Absolutely. So probably some of the savviest investors in the country may not be taking that approach, but the fact is they have probably years and decades of experience about when to time and when to shift from one fund to another. But my strong advice is that depending on your debt horizon, you should choose the funds. For instance, I mentioned about target maturity funds. So if your investment horizon is 5 years, usually as a retail investor, you do a 5-year FD. Similarly, a target maturity fund can be thought about the same thing. If your investment horizon is 5 years, you can probably do a 5 years target maturity fund. Similarly, if your investment horizon is lower and you might need to withdraw your money sometime in future, probably to buy a house or something else, you don't want to invest in a 5-year or a 10-year duration fund, then it's probably better to be in a short-term fund, as I mentioned, which may not give you any significant capital losses even in the worst of the times.
And how are credit risk funds looking at this point of time? Are they a good bet?
I think I will qualify my answer. It will depend a lot upon what risk each credit risk fund is taking, because in the industry you will have very different risk profiles between the credit risk fund. But generally speaking, we don't, as a fund house, and me personally, see significant credit risk building up in the country. We had a little bit of stress scenario for most of the companies during the COVID time. And if there was any stress in those companies, it came out at that time. And right now they have passed, most of the companies have passed that stress test. On the other hand, the economy is doing well. Yes, we do understand that the growth is not tapering off, but it's still not really low or anything to worry about. Thirdly, what has happened is, especially, a lot of the credits is given to NBFC space and all. And in the last few years, what we have noticed is Aadhaar has really tightened up this the monitoring of the loans that you give to retail investors. And also, largely by and large, we are not really negative on credit risk on the country. However, that doesn't mean that I will say that blank should invest in credit risk funds. One has to look at the risk profile of the credit risk funds. Another thing, I would says that one needs to look at whether credit risk funds are actually giving significantly more returns than the other fund categories which don't have that credit. I personally, and this is my personal view, I prefer right now to allocate more funds on which are not credit risk funds. Historically speaking, the credit risk spreads are not as wide as they used to be. Having said that, I really don't see significant risks in credit risk in the country, and it's up to the investor profile. If they want that higher carry, they can go for it, even though it's not my preference. Personal preference, let me add that.
Thank you, Mr. Yadav. It has been a pleasure interacting with you. I'm sure our viewers will learn a lot about investing in debt mutual funds by watching this video. Thank you so much and have a good day.
Thank you very much. Thank you very much for having me here.